on the end of the table over there. We're just going over the practice questions, or we will go over them in about 3 minutes. Oh, you're gonna have to give me both pages. Yeah,
Oh, I'm sorry.
that's okay.
Yeah, that is my name. Okay, yeah.
You're Riley.
Oh, I didn't look at that. Yeah.
If anybody else has the group work for chapter 10 to turn in, you can turn it in. Thank you. Okay, so let's go ahead and go through these. First question says, the interest rate written in terms of the bond indenture is known as coupon rate, nominal rate, or stated rate. And the answer is D. The English language, we like to call a bunch of things the same stuff. Sometimes what makes accounting challenging. When the interest payment dates of a bond are May 1st and November 1st, a bond issue sold on June 1st, the amount of cash received will be by the issuer. So this is the company issuing the bond, and they're selling it between interest payments dates. And so you have to increase the accrued interest for that 1 month. So that's also D. An early extinguishment of bonds payable, which were originally issued at a premium, is made by purchase the bond between interest dates. At the time of reacquisition, any costs of issuing the bonds must be amortized up to the purchase date. So that is true. The premium must be amortized up to the purchase date. That is true. Interest must be accrued from the last interest date to the purchase date. And so the answer is D. All of them are correct. Hannah, grab one of those, please. Any questions on the first three? A corporation borrowed money from a bank to build a building. The long-term note signed by the corporation is secured by a mortgage that pledges title to the building as security for the loan. The corporation is to pay the bank $80,000 each year for 10 years to repay the loan. Which of the following relationships can you expect to apply to this situation? The balance of the mortgage payable at a given balance sheet date will be reported as a long-term liability. So it's kind of reported a portion short and portion long-term, right? Because we're going to be paying $80,000 each year. That $80,000 will be current, and then you'll have some long-term. The balance of the mortgage payable will remain constant over the 10-year period. So we know because we're making payments, we're going to be applying some to the principal. The amount of interest expense will decrease each period the loan is outstanding, while the portion of the annual payment applied to the loan principal will increase each period. So this is actually correct. And you can think about it, if anybody's ever bought a car, your payments, as you go further on, more and more of the payments apply to the principal because the principal gets knocked down. And so there's less and less interest there. A debt instrument with no ready market is exchanged for property whose fair value is currently indeterminable when such a transaction takes place. So normally you're supposed to value the transaction based on one of them, which you kind of know the fair value. In a situation where you're not sure, present value of the debt instrument must be approximated using an imputed interest rate. Okay, so hopefully we know what kind of bonds there are now. I'm sorry, hopefully we kind of are familiar with just the basic bonds. And these are some of the types of bonds that are out there. This is not from your book. I copied the excerpt out of another book, but it just kind of explains to you some of the terms for bonds, and I'll go over some of the important ones now. So for discount, issuer receives less than face value of the bond. This means the market rate for similar risk is higher than the interest that the bond is paying. Okay. Premium. Issuer receives more than face value of the bond. This means the market rate for similar risk is lower than the interest that the bond is paying. So just a little bit about bonds while you're finishing writing that down, and you don't need to write this down, but just FYI. Typically, bonds take about 6 months to a year to get processed and set up. And so a business will go to a bank and they will say, I'd like to have a bond. And so the bank will say, okay, we're going to come in, we're going to do this work. And then they'll also go to a ratings agency like Moody's or Standard & Poor's, and they'll come in and they'll check out the company and they'll say, you know, whatever this debt is rated at. And so they'll give your debt a rating. Now you've set your interest rates, let's say 6 months ago. So we all hopefully have seen finance news, and we know that they can cut interest rates and raise interest rates. So we just had a 0.5 point interest rate cut. If you did not anticipate it as a company, you might have a bond that, let's say, is paying 7.5%. Well, that interest rate cut happens, and now all of a sudden you could have gotten away with paying 7%. So what happens is the market adjusts the price of the bond via the discount or the premium. So effectively, you're going to pay 7% because that's the market rate, okay? So bonds at par are just sold at face value. You might see bonds sold at 100. And all this is a percentage without the percentage sign. And so bonds at par would be sold at 100. And to record that entry, you would debit cash or asset. And when I say asset, it could be like a truck or something like that. And then you would credit bonds payable. Now we accrue interest. And so we debit interest expense. Ooh. And we credit interest payable or cash. And remember, interest expense is calculated by the face of the bond. Principal times rate times time. Bonds at a discount or a premium. So you would debit cash, asset. You would debit discount on bond payable. And this is the difference between cash and the bond. And then you would credit bonds payable. And then bonds sold at a premium would be a debit to cash or asset. Credit to bonds payable. And then a credit to premium on bonds payable. Okay. So you would debit the cash, you would credit bonds payable for the face value of the bonds, and then the premium on bonds payable would be different than the cash. Now, we have to amortize the discount or premium over the bond life. And straight line is not GAAP, but acceptable if not material, which means if it's not something that investors would care about on your financial statements, then you can use the straight line method. So I should say not materially different than effective interest method. That's a better way to state that. Okay, hopefully that's enough time for everybody to get caught up. And so we have the effective interest method, and we use this per gap if interest expense is material. Okay, so steps to use the effective interest method. Now, you guys have done this before. It's nothing sort of new. You're just using bonds now as opposed to having assets. So let's say that we take a loan to pay for a building, or I'm sorry, not a loan, a bond payable. $348,000-ish. Okay. So what you would do is you would say, okay, and we make 4 payments of 100,000 at the beginning of each year. So at the beginning, our carrying amount is 348,000. We pay 100,000. We don't have any interest expense because it's on the first day, right? So this would be year one. The discount does not get amortized, and so your carrying amount at the end of the period is going to be 248,000. Okay, so now year two, we have 248,000. We're still going to pay the 100,000. But now we're going to have interest expense, and our interest expense is the 248,000 multiplied by 0.1 for a 10% interest rate. Oh, that is so annoying. And so that equals 24,800. So the discount amortized would be the 100,000 payment minus the 24,800. And so that should be, I think, 75,200. Let's see. Ooh, too many zeros there. Okay, 75,200, good. Okay. So then now we're going to take and subtract the 248,000. Going to equal 172,800. So now year 3. So we have 172,800. We're still paying 100,000. And I'm going to put the fourth payment in just so I remind myself not to put in anything else. Okay. And so here now we have 172,800 times 0.1. And that equals 17,280. So now we have 100,000 minus 17,280. So I get 82,720. So now I'm going to subtract that from the 172,800. And I get 90,080. Okay. Now you guys finish this up. And I'll give you about a minute. So what do we get for interest expense? Okay, 9,008. And that's correct, right? That's 90,080 times 0.1. And that equals 9,008. And so here, 100,000 minus 9,008. What's that equal? 90. What is it? 992. In which you would adjust it, that last payment to be a little less than 100,000, and you'd end up with 90,080. Okay, so that's an example of the effective interest table. You've done it a couple times. Sometimes this column, as you didn't have on yours, won't be there, but it's just a duplicate of this column lagged. Okay. So this is a little handy helper for you. Bond interest expense, carrying value of the bonds, times the effective interest rate, minus the face value of the bonds times the stated interest rate, and that equals your amortization amount. That's just kind of a helpful guide for you. So let's look at examples 1 and 2 now. Okay. On January 1, 2020, Ellis and Company issued 8-year bonds with a face value of $6 million and a stated interest rate of 6%, payable semi-annually on June 30th and December 31st. The bonds were sold to yield 8%. Okay. I don't know why my thing's not popping up. All right, so now we have to pick, okay, and figure out which one of these we're going to do. So how many periods do we have? We have 8 years, payment of interest 2 times per year. So 8 times 2 equals 16 periods. Okay. So we've got that. Now the question says, are we going to be paying payments on it? Are we just going to be paying the $6 million back at the end of 8 years? We're just making interest payments. We're not making any payments on the principal. So this is the present value of 1 for 16 periods at 4%. The interest rate is calculated by taking the yield and dividing by the number of payments in the year. So in this case, 8 divided by 2, and that equals 4. So the present value of this would be 6 million multiplied by 0.534, and that comes out to be 3,204,000. Okay. Any questions there? All right, let's look at number 2. It says the present value of interest. So our interest payments are, you got to take the 6 million and multiply it by 0.06, which is the face or the stated rate. And so 6 million times 0.06 is 360,000. Interest paid per year. We take the 360,000, we divide it by 2 payments per year, and we get 180,000 payment each 6 months. Now we have to pick the correct factor. And so we want a present value of an annuity for 16 periods at 4%. So you take the 180,000 and you multiply it by 11.652. And that equals 2,097,360. So you guys are familiar with factors and familiar with the annuity tables. I know we talked about them before, but if you have questions, please let me know. Okay, we got a practice question for you next. Please take a couple minutes and calculate what are the proceeds from the bond issue. If you're not sure where I start, just calculate both of the pieces, like examples 1 and 2 did. As I come around, if you have any questions. So there's 2 payments. Your payable semi-annual on June and December.
Times about 8 years.
Yes.
Okay.
And that gives you the number of periods. You're welcome. Okay, so what am I going to do first? I want to take the present value of the bond principal, and that's 5 million over, we had 5 years and interest paid 2 times a year. And so that's 10 periods. Bonds yield 5%. So we know that we have to divide by 2 because there are 2 payments per year. So we have 2.5%. So this is our first that we're going to use to calculate the bonds. So we have 5 million and we multiply by 0.78120. And we end up with 3,906,000. And then now we need the present value of the interest payments. So interest is paid at 6%. So we take the 5 million and we multiply it by 0.06, and that's 300,000. And then we divide by 2, because it is paid semi-annually. So we have 0.03 or 3%. Sorry. And so that equals 150,000 payment. We take the 150,000 and we know we're going to get it twice a year. So we have for 10 periods and we're at 3% interest rate. 8.53020 is the one we're going to use. Oh, no, hold on. Sorry, it's supposed to yield 2.5. My mistake. So 8.75. So we multiply that by the present value factor, 8.75206. And that is 1,312,809. So we add present value of principal and interest payments. And you end up with 5,218,809. And so our answer is C. Take a minute to look that one over, or 30 seconds. And if you have any questions, please let me know. Okay, no questions. We'll jump to example 3. Company issues 15 million, 7.8%, 20-year bonds to yield 8%. Interest is paid on June 30 and December 31st. The proceeds from the bonds are 14,703,108. Using straight line amortization, what is the carrying value of the bonds on December 31st, 2021? So first of all, is this a discount or a premium? Right, it's a discount. Yeah. So our entry, if we were to record this, would be a debit to cash. 14,703,108. And then a debit to discount on bonds payable. And this amount is 296,892. That's just the difference, the 15 million minus the 14,703. And then you're going to credit bonds payable for 15 million. Now we amortize the 296,892 over 10 years and 2 times a year. So 20 periods. So we have 296,892 divided by 20. and we get 14,844 basically. And that's oh, these are 20-year bonds. Sorry, this is 20 years. So we divide it by 40. And so we get 7,422 amortization per period. How many periods? So we have January 2019 to December 31, 2021. So that's 6 periods. So we take the 6, multiply it by the 7,422. And that equals 44,532, which we add to the 14,703,108. And we get 14,747, 642, something like that. And so that's due. Any questions? Now, what I would like you to practice is I'm going to copy this from up above. And we'll plug these things in just to talk about this briefly. And we'll show you how this side of it works. Okay. So our cash paid amount, 15 million. Times 0.078 equals so 1,170,000. And we're going to divide that by 2 because there's 2 payments. And so we get 585,000. Now this would be 7/1 year 1, 1/1 year 2. I think that's when they, right? June 30th, okay. And our interest expense, 14703, 108, and they're supposed to yield 8%. So we take that 8% and we divide it by 2. And so we end up with 588,124. So you'll see the discount 588,124 minus $585,000 is going to give us $3,124. So we take the 14,703, 108, we add the 3,124, and that equals 14,706, 232. Now, if we were to keep going, we would get close to this number, but we would not get the same number because we're using the effective interest method. Okay, so if you were to do that, that's what that would be. Okay, let's jump to example 4. A company issues $15 million, 7.8%, 20-year bonds to yield 8%. So it's the same information. The proceeds from the bonds, what is the interest expense for 2021 using straight line amortization? Okay, so we have interest payments, 15 million times 0.078 divided by 2, and that's 585,000 per 6 months. So multiply by 2. And I think that was 1,170,000. Now we have to add the amortization of the discount from example 3 above. That equals 7,422 per year. And so we have 1,177,422. Oh, this is twice, I'm sorry. It's not per year, that's per 6 months. We'll multiply by 2. And that equals 14,844. So 1,184,845 is our answer. Okay, example 5. It's the same information. It says using the effective interest amortization, how much interest will be recognized in 2020? So this is the first part of 2019. And so let's go ahead and finish up 2019, 14,706. $232. We know the payments are going to be $585,000. Also in year 2, which you're going to get to calculate. Same. And here we have 14,706. Nope. 706. 232 multiplied by 0.04. And I get 588,249. So 588,249 minus the 585. And this equals 3,249. So we add 3,400 or 249, and we end up with 14,709,481. Okay, so it's asking, example, how much interest will be recognized in 2020? So your interest expense, 588, 124 plus 588, 249. And that equals 1,176,373. And this is C. Are you guys looking at this one? Tell me what the answer is to number 6. Should be straightforward, right? It's asking, what will the carrying value of the bonds be on December 31st, 2020? So this is 2020. What's our carrying value at year end? Right. This is our carrying value. And so our answer is okay. You guys got practice number 2 here, and then we are on to practice number 3, and that is it. By the way, if you want to make this one look exactly like the other one, you just put another column in here and just call it carrying amount at beginning of year. Give you another minute for that first practice number 2, and then we'll start to go through it. Okay, so our carrying amount at the beginning of the year is 2,154,500. All right, so this is at a premium. So how much cash is going to be paid for interest? You have 2 million times 0.12 divided by 2, because we are payments twice a year. And that should equal 120,000. Our interest expense, 2,154,500 multiplied by 0.1, because it's 10% yield. And we have to divide that by 2. $107,725. And so the discount amortization, 120,000 minus 107, 725. $12,275. And we get 2,142,000, 2,142,025. 225, sorry. Okay, so that's 6 months interest expense, right? So now we have 2,142,225. We know we're paying 120,000. And then we have the 2,142,225 times 0.1 divided by 2. This is 107, 111. So I got 120,000 minus 107, 111. $120,000 minus 107, 111. 12,889. $2,129,336. And so this would be 6/30/2020. And this would be 12/31/20. And so all we have to do is add interest expense. 107,725 plus 107,111. And that equals 214,836. And so that is answer B. Any questions? Okay. All right. I'll give you about 5 minutes to do practice number 3. Okay, I'm going to come around. I want to see everybody starting to do this. If you have questions, please ask me. It's the same format. Just keep in mind that we've got different numbers now. You want the answer for practice. You should after you guys should be trying to make a chart like this for this one. It'll be easier if you just make the chart like this for this one and then plug in the values. You can make like a chart like this one and just put it underneath there. You're doing nice and down. That's smart. There were a few extra lines on the practice too. So if you wanted to do it on those bottom 2 lines, you could. I didn't give you a lot of space. I apologize. Okay, so what do we get for the carrying amount at the beginning of the year? Good, 2,768,000. And then we have to calculate the cash paid, so that's gonna be 3 million, the face value of the bonds. And they're paying 8% twice a year. So we multiply that by 8% divided by 2. And we get 120,000. Our interest expense, we take the 2,768,000, and now we want to know what is our effective rate. And so we have to look for the yield. The yield is 10%. And so we multiply it by 0.1 divided by 2. And I get 138,400. So amortization of the discount, 138,400 minus 120,000 equals 18,400. And so the carrying bonds, value of the bonds, 2,768,000 minus, no, this one's add, right? Add 18,400 because we're trying to get to the 3 million face value. And so that equals 2,786,400. So now we we carry down the carrying amount, 2,486 or 786,400. We paid 120,000. We multiply the 2,786,400 by 0.05. We get 139,320. 139,320 minus 120,000 equals 19,320. And we end up with 2,805,720. That was the 0.1 divided by 2? And so we want the interest expense amount. So we add semi-interest. We had 138,400 plus 139,200. And that equals 277,720. Or answer C. Any questions? Okay, so on Thursday, we're going to work on the group work in class. And then we'll jump to chapter 12 instruction. Thank you. Have a great day. See you on Thursday.